But listen to how he said this process is simple and easy. You're trying to add every type of ICT concept. You're overcomplicating your system. So that way when you execute, you're not second guessing yourself. You're like a headless chicken running around placing trades. You're entering on every displacement candle. Alright y'all, so today we're reacting to the golden child Jadecap, the simplest trading strategy for beginners in 2026. Let's get right into it.
I'm about to show you how I get results like this, and this using a strategy so simple that even a complete beginner couldn't mess it up.
So all y'all people who suck at trading, keep y'all ears open.
This strategy has 3 steps. First, you'll learn how to find your key levels. Next, we'll be confirming our entry. And last but not least, will be trade management. But
one thing I like about Jadecap is that he keeps it very simple because he know that simplicity is key. The fact that he had $2 million in payouts with Apex, you gotta listen to what he's saying.
Here's the thing, most traders completely overcomplicate this process, and that's exactly why they're bleeding their accounts dry. I spent years doing the same thing until I figured out this approach that changed everything. So let me show you exactly how this works, starting with step 1. First of all, if you don't have a simple and repeatable way to find your levels, then nothing else matters. You could have the best entry confirmation in the world, you could have perfect risk management, but if you're marking the wrong levels, you're just gambling. And I had to learn this the hard way. So back when I was unprofitable, I'd be sitting at my charts marking what I thought were levels, but here's what I didn't understand. I was marking levels based on what I wanted to see and not where the big players were actually looking. And
that means stick to the higher time frame chart, guys.
That cost me thousands of dollars. The first trait of a high probability level is that it needs to have untapped liquidity sitting above or below it. Now, what does that mean? It means that there's stop losses clustered at that price point that large traders want to grab before making their real move. Now, I know what you're probably thinking, Kyle, this sounds complicated, but I promise you, once you see this on the charts, it becomes second nature.
I don't think we're thinking about that, Jadecap. I don't think this sounds complicated, bruh.
So let me walk you through the levels I'm talking about. First of all, let's talk about our trading sessions. Now we have Asian range, which is 8 p.m. Eastern up until midnight Eastern. And then we have London range, which is 2 a.m. Eastern to 5 a.m. Eastern. So inside of each one of these ranges, we have session highs and session lows.
Now, isn't that simple to y'all, bruh?
So inside of the Asian range, we'll have a high and a low. And then inside of the London range, we'll also have a high and a low. So on top of these session highs and lows, we also have previous day highs and lows.
And these don't change, bro. They stay. You know how you have support and resistance areas that's always changing, that's very subjective? Highs and lows are not subjective. They're facts. There's no second guessing what that high or low is.
And last but not least, we have New York session, which is 8 a.m. Eastern up until 12 p.m. Eastern. Now, this session becomes our trading session. Now, when I sit down in front of the charts, what I'm looking for are the swing points that are being created. So simply put, a swing low or a bullish swing point is a candle where both the candle before it and after it have higher lows. So you guys can see here for the bullish swing point, we have a low, a lower low, and then a higher low. So this here creates our bullish swing point. And vice versa, we have a high, a higher high, and then a lower high. And opposingly, a swing high is a candle where both the candle before it and after it have lower highs. So we have this high, a higher high, and then a lower high. So this point here becomes our bearish swing point. Now,
simple, bro, simple.
These swing points inside of these sessions and the previous day become very, very important. So when I sit down in front of the charts around 7 or 8 p.m. at night, this is what I'm typically doing. I'm sitting down and I'm marking out all of the hourly swing points from this specific trading day. So you guys can see here that we marked out our swing low in here. We have another swing low, we have a swing high, and a couple different swing highs up here. Here's another example where maybe I'm sitting down on Friday getting ready for Monday's trading day, and I'm marking out all...
Damn, this price section look ass.
All the swing points that are being formed inside of this specific day. Now, if we've taken out specific swing points, I will not mark those. And one last example here, again, it's a Friday, so maybe I'm getting ready for Monday's trading day. What I'm going to do is sit down around 7 or 8 p.m. at night and mark out all of the intraday swing points that I see on the hourly time frame, just to prepare me for the following day. All right, this process is very, very easy. It should be very straightforward. It should only take you 5 to 10 minutes to do this across one market. Now, if you follow multiple markets, which I tend to do, maybe it only takes you 30 minutes to 45 minutes.
But listen to how he said this process is simple and easy. That's the main thing. If your process is so many complicated things added, and you're trying to add every type of ICT concept or every type of trend line and indicator and support and resistance areas and shit all over the place, bro, you're overcomplicating your system. And that's a problem.
So just quickly scan across all the markets that you're trying to trade. Maybe you're trying to trade precious metals, gold, all these different commodities, the index markets, currency markets. It doesn't take that long to sit down and plot out all of the swing points. But here's where it really gets interesting. And this is the part that nobody talks about, right? Finding the level is only 30% of the equation, because once you've identified where price might react, you still need to confirm that big money is actually showing up. And you still need proof that your analysis is correct.
So you need confirmation.
That's exactly what I'm going to show you in step 2, which is confirming the entry.
Voila.
So we've learned how to mark levels, but how do we actually take trades and make money? Because knowing a level alone is useless if you don't have a way to confirm it's valid. Now, I learned this lesson the most expensive way possible. There was a trade I took back in 2019. I had marked out what I thought was a perfect level. It had everything I just showed you: liquidity, higher time frame swing point. I was so confident that when price approached that level, I didn't wait for confirmation. I just entered immediately because I knew it was going to hold. And the market swept right through my stop loss and continued another 50 points.
And as an emotional trader, that's gonna get to the point to where you might go on tilt. Because one time I got knocked out of a trade doing the same shit with a little and entered with a little 2-pip stop loss over the OB. This is when like smart money SMC concepts were like really trending with 1 to 10s and top ticking and bottom ticking, the same type of trend it is nowadays. Well, back then in 2020, we had 2-pip, 1-pip stop loss type trends. And I got smacked out once, tried to enter again, got smacked out again. And then when the real confirmation happened, I missed out on that move because I was fearful of getting hit out again. And after that happened, I revenge traded, went on tilt, blew a FTMO account. It was a big learning lesson.
The wrong direction. I lost thousands of dollars on these trades because I didn't wait for confirmation. And that's when I realized the level is just an area of interest. Confirmation is what tells you the big players have actually arrived. So what is confirmation? Confirmation is price action that shows you order flow is shifting at your level. It's proof that the big money is taking the opposite side of the trade from all the retail traders who just got stopped out. Now, after the liquidity sweep, you need to see a strong move in the opposite direction. Not some weak, slow grind. I'm talking about a decisive candle that closes back in the range after taking out the previous swing point. Now, this shows commitment. This shows that the big traders are actually defending that level. Now, let's talk about what proper confirmation actually looks like. So here we have a bullish swing point and price runs through that level. So now we just don't do anything. What we're looking for is an actual closure of the next hourly candle that confirms the long. Now, we don't drop down into a lower time frame chart until this hourly higher time frame candle confirms that we have a shift in order flow.
Now that next candle, when that next candle opens, it should open, come down low, and then start running higher. So you could get an entry there, which is stop below here, targeting whatever your draw is, your targets are. You know what I mean?
And opposingly, if we're bearish, we're looking for this swing high to be rated and then a closure back below into the range to confirm the short. Now, if these candles haven't yet closed and they're just kind of wiggling around, maybe there's 30 minutes, 45 minutes left till candle closure, we are absolutely not going to drop down into a lower time frame until the hourly closes.
Then you drop down.
So now that you guys know what to look for as far as confirmation, let's get into the actual trade entries. All right,
let's go. I love trade entries. Let's go. Oh my God. Oh shit. Oh shit, my fault, y'all.
End of Monday, right, around 8 or 9 p.m., I will typically sit down and mark out my swing points. Now, if we miss swing points overnight, we can always come back in the morning and double check them and plot our swing points just so we have an idea of what's going on. So not only do we have these swing points, but I also want to note that we are in this very large sell sign imbalance. So maybe I am leaning bearish for the following day. So what we're going to look for is obviously a raid on one of these swing highs and then a closure back below. So let's keep fast forwarding through until we get to New York session. So we're not looking at anything yet. Right now, it's still London session.
I'm not gonna lie, I'm gonna be bullish in this, bro. If I see some displacement higher like this, bro, I don't even care about that gap, bro. And it's already rated lower.
So none of these trades right now, or none of this price action, to me is concerning. All right, now we have a raid on this swing high and then a closure back in the range. So what we're looking for is the following couple hours, then we can drop down into a 5-minute chart. So here we are approaching 8 a.m. and it's still a little too early for us to find a trade. So let's keep fast.
Okay, this is looking bearish now, I ain't gonna lie.
Fast forwarding towards equity open. All right, we have our 8:30 candle. So we are about 1 hour before before equity open. Now let's keep fast forwarding. All right, now we have a fair value gap that appears, and we are in our session window. So what I'm going to look for is a retracement back up to this fair value gap. All right, so we have our retracement back to the fair value gap. What I'm going to do here, and right now it's 850. So this is an opportunity where we could possibly anticipate that maybe before the equity open, we're able to position ourselves, expecting that the equity open is going to send this market lower, because we already have what we're looking for. We have a swing failure pattern, and we've closed back in the range, and now we are approaching our actual trading session window. So what I'm going to do is place a short position here. Obviously the stop loss goes in a logical area, and maybe I'm just going to target 2 to 1. So let's fast forward. All right, here's our equity open. Obviously, if we didn't get short, we could have possibly looked at getting short on this fair value gap after equity open, and there we go. There's 2R. Now, as you guys can see, let's say if you didn't want to enter ahead of the equity open, this was still a good setup. So we had a retrace.
Now, a lot of y'all people who trade, like, y'all are scalpers. Y'all may not want to do this. You feel me? Entering before equity open. But if you're trying to get that daily candle expansion, it's not bad to enter before the equity open, especially because as long as your stops are a little bit wider, you know what I mean? And you're not trying to jam your stops. Taking inversion FEG trades before equity open on a 1 minute inversion FEG, you're gonna get smacked out. Smack now, you know what I'm saying?
To this fair value gap, we got a nice closure here. So let's say if you want to go short here, put your stop loss maybe above this swing high, this 5-minute swing high, and still target a 2 to 1.
And Jadecap, you're tripping right here.
Okay, this trade is giving you plenty of opportunity. In fact, it ran 5R. All right, here we have another trade example. This is Friday, December 5th. So obviously when we sit down, we're trying to plan for Monday. And as this market trades, obviously you guys can see when I sit down at 8 p.m. or 9 p.m. Eastern to mark out my levels ahead of the weekend, what I'll do is mark out all of my previous swing lows and swing highs. And let's say we're a little bit unsure of which direction the market wants to go.
Because I ain't gonna lie, how do you know where the market is going with this type of price action? This is the type of days where you de-risk.
For the following day. That's totally fine. We're not looking for a very, very clear bias. It's okay not to have a bias with this strategy. So let's keep fast forwarding until we get to...
Okay.
Equity open. Right here we have a swing point, so we can mark out this swing high here as well. So leading up into equity open, we have our levels marked out. Okay, here's 5 a.m., 6 a.m. This candle closed at 8 a.m. This candle closed at 9 a.m. And then here we have a candle leading up to 10 a.m. So here you guys can obviously see we have this swing high, and we've closed back inside of the range.
Okay, so buy stops hit. Okay, so we targeting these lows now. Say less.
Now, this I am leaning much more bearish on based on this hourly candle.
I don't blame you.
Right? Because we've rated out the swing high and we've got a nice closure. So what I'm looking for now that we've had our higher time frame confirmation, this is the only time I'm dropping down into the lower time frame. I do not drop down to the 5-minute time frame until I have this higher time frame confirmation. So what we're going to do is drop down to a 5-minute chart and see if we can get an entry. So here we don't have any 5-minute.
There's no fair value gap. I'm not taking that shit.
Fair value gap that we can look at, but what I do see is a 5-minute order block and a 5-minute breaker. So we have the low of this up close candle and we have a breaker in here. What I'm going to look for is a retracement up into this level so we can get short and then position ourselves for a run low.
Now in y'all rules, if you do not trade breakers or order blocks, you're not taking this unless you have that fair value gap. If it's in your rules to only trade fair value gaps, then you're not taking this. So
let's see if we get that retracement. All right, here it's retraced. It's basically hit this level. So I'm going to anticipate a short position here. Let's say we're going to put our stop loss at maybe 50% of the breaker. And again, we're just going to target 2R. Now, you guys can see here that my target aligns with these swing lows from the previous day. And that's a good target to have. So let's fast forward and see if this trade pans out. Right now, it's about 10:20 a.m. And there we go. This trade eventually hit 2R. And you can see the reaction after we've swept out those swing lows. Now, this trade eventually did make it about 3R. So even if we entered a little bit late, or you didn't get the exact perfect entry with stop loss, there's still plenty of opportunity to position yourself.
Okay, there's too much subjectiveness in these entries. You feel me? Now, if I was y'all, I would put my stop right above the breaker. If you have a fair value gap, that's a 3-candle pattern. Keep your stop above the first candle. Simple entry. And if you have a fair value gap, shit, let's say if there was a fair value gap inside of here, stop right up in here. Simple. I know a lot of y'all, if you was to enter this and you got smacked out right here, and then it started dropping lower again, you're gonna re-enter that. So what does that mean? Then your you're over risking now, because guess what? You got hit out maybe at 1R, 1% there. So now you're entering another 1%. What if the price goes against you and you get hit out again? That's 2% right there on that one trade. Put your stops where you're most likely invalid, which is above here.
Inside of the trade. Now, let's say if you were only trading fair value gaps, let's say if you wanted to enter short on this one, let's see what this position would have provided you. Let's say you wanted to enter here, put your stop loss here. This trade still would have provided a 2R. Now, one last trade example, we have Friday, which is 12th of December. And what I've done at the end of the day, obviously 7, 8, 9 p.m. Eastern, I've sat down in front of my charts and I've marked out all of the previous day's swing points in preparation for Monday's price action. So what we're looking for, let's say if we're bearish overall, is we're looking for one of these swing highs to be rated, and then we get a closure back into the range. So let's fast forward, leading us up to equity open. Here again, we have equity open, and as you guys can see, we've rated out this swing high and closed back inside of the range. So once we have this confirmation, then and only then am I dropping down to the lower time frame. So let's hop down to a lower time frame and see if we could find an entry again. So here we have a 5-minute time frame, and now we have this 5-minute fair value gap. So what I'm going to do is plot this out. You guys can see the time of the entry.
Well, here's your fair value gap. We want you to stop right up here. 1, 2, 3, 3 candle pattern with a fair value gap. Put your stop like up above the first one, not inside of here, because if you get hit out and it's just a wick, because wicks do the damage, bodies tell the story. The wick can come all the way up here and still close around here and still go lower, and then you're mad because and you have FOMO because you got hit out of that trade, and now you could potentially miss the trade.
5 a.m. right in our session window. So what I'm going to do is plot a short position here. Now let's say we're going to just target 2R, and our stop loss is going to go above this high because we've already traded up to the fair value gap high, and we're just looking for this continuation lower. There we go. Now I urge you guys all to go back into your charts and study these examples. Plot out your swing points in preparation of the following day, and do not look for an entry on the lower time frame until you get confirmation of that higher time frame. But here's the thing, and this is where I'm going to blow your mind. Even with a perfect level and perfect confirmation, you can still lose money if you don't manage the trade correctly, because the entry is just the beginning. What you do after you place the trade is what separates the profitable traders from the ones who keep blowing accounts. Trade management. Now, this is what's going to make or break you, because as you've seen, it's not that hard to mark out a level and confirm it. The money is made or lost after the trade is entered. Now, let me tell you about my biggest trading mistake. It was 2020, middle of COVID. I had finally started to figure things out. Now, I found the perfect setup on the NASDAQ. Textbook level, perfect confirmation, everything aligned. I entered the trade, and within 30 minutes, I was up 200 points. I was so excited, I took a screenshot and sent it to my buddy who got me into trading. But here's where I messed up. I didn't have a plan. I just watched the trade, hoping it would continue running. And you know what happened? Price pulled back, hit my stop loss, and I walked away with nothing. And not only did I lose 200 points of profit that I had, but I also took a loss on the trade because I didn't move my stop and I didn't take a partial before lunch. Now, that was the day I realized that trade management isn't optional. It's something you have to figure out on the fly.
Jadecap, you was trading for 9 years, 10 years, 11 years. You telling me 2020 was when you finally realized that trade management was important?
And you need a system, you need rules, because when you're in a trade and money's on the line, your emotions are going to destroy you if you don't have a plan. So the first rule of my trade management is setting your stop loss in a logical place, not based on how much you want to risk, not based on some percentage of your account, based on where your analysis should be wrong. So for a bullish trade, your stop goes below the liquidity sweep and below the low that was just created. For a bearish trade, it goes above the liquidity sweep. Now you can dial it in even more, just as I showed you guys in the examples on that 5-minute time frame based on fair value gaps.
So rule 1, stop loss placed at a logical level. You see how I'm saying? Look, first, this is actually the candle that created the fair value gap. But here's the first one, here's the second one, here's the third one, right? If the first one if the second candle raised the first candle's high and then drops lower, then it's logical to keep your stop loss above there while you're taking your entry.
Order blocks, but you want to ensure that if you get stopped out, it's because your analysis was wrong, not because of normal market noise. Now, I used to put my stop loss in just random places because I wanted to have more size on, or I wanted to have a tighter stop loss with bigger risk reward. And I just realized that over time, that actually hurts you more than helps you. Now,
facts.
Second rule is understanding your profit targets. And this is where retail traders really get it wrong. You're not just picking a random spot on the chart and hoping price gets there. You're targeting the next logical liquidity pool. Whether that's a previous low, previous session low, or previous swing points from yesterday, you are targeting the next logical liquidity pool. So as you guys see here from that trade example, we did have a 1 hour inefficiency down there, and we had previous swing points that aligned with our targets. So before you place the trade, just ask yourself, do I have a logical area that I can exit this trade or take a partial? Now, the third rule, and this one changed my entire trading career, is the concept of partials.
So for back to rule 2, understand your profit target. That means make sure you have a clear target. Relative equal lows, 1 hour inefficiency below the relative equal lows. If you're buying, relative equal highs, Asia high, a clear London high that may have relative equal highs up there. Simple, bruh. Before you enter your trade, not enter your trade and just randomly aim for 1 to 3, 1 to 4, 1 to 20.
Not only based around price, but based around time. Now, just remind yourself of this. You don't have to be all in or all out. Okay, when price hits your first target, let's say we had some of those swing lows, take 50% of your position off the table. You
don't be greedy. Take something out. Partials always pay.
Lock in a profit and you guarantee that the trade is a winner. Because not only that, but then you can set the remaining 50% and allow it to run to a second target. Now, not only should you have price exits, you should also use time exits. If you're an intraday trader, you need to understand that you're giving a lot of money back by trying to hold through the lunch hours. And this approach solved some of the biggest problems I had in my trading. I was always trying to catch the entire move. I'd be up 50, 75, 100 points, and I wouldn't take anything off going into lunch because I thought it was going to run 200. And then it reversed and I'd lose and find myself sitting in a losing trade through the afternoon. Now with partials, you're capturing profit while still giving yourself the opportunity to catch those big moves. So as you guys can see over here, if you took a partial based on time, so I will always have in the back of my mind when 10 a.m. comes around, 11 a.m., the further and further you hold that trade into lunch hours exposes you to time in the markets. And oftentimes around the lunch hour, we get these massive retracements. Now, if you don't already, put a clock on your desk. Start keeping track of all the data behind when a market moves. And
he said, put a clock on y'all desk. Like, we ain't got, like, who's gonna do that? It's not 1997, 1990 no more, bro. We got phones, bro. Set a timer on your clock. For when lunch hour comes, bro, you're done. Or you take partials, or you know whatever's in your rules, what you should do.
Why it moves. You're going to often find that a lot of these markets die out before lunchtime. And a lot of times these markets make their move early in the morning, and then by lunchtime, they kind of peter out and die. Now, here's what nobody really tells you about trade management, guys. It's not just the technical stuff. It's about your psychology. It's about discipline. Because the strategy I just showed you is worthless if you don't follow it when you're actually in a trade. If you're holding that trade through lunch hours when you said you were going to take a partial and adjust your stop loss, you are doing yourself a disservice in the markets. Now, let me tell you a little story and experience that I've had in my trading career. When I finally quit my job in 2022,
let me move myself over, bro.
About 6 months of savings to make this work. Now, that pressure was extremely intense. Every losing trade felt like I was one step closer to having to go back to work, and that pressure just made me do stupid things. I'd move my stop loss further away when a trade was going against me, hoping it would turn around. I'd close winning trades too early because I was afraid of giving back profit, and I'd revenge trade after a loss because I was frustrated. Maybe I held that trade through lunchtime. And it wasn't until I stopped.
Now, we all can relate to this bullshit.
Stopped caring so much about the money that everything changed. I started following my rules no matter what. I had logical stop losses. I would trim partials ahead of lunch hour. I moved my stops to break even when it was too late in the day. Now, build those really good habits and just rinse and repeat. Those small changes is exactly how I went from struggling to making my first $100,000 payout, then $500,000, and then over $2.5 million in one payout.
Now listen, the fact that he just said you want to build those habits. And how do you build those habits? Around your rules that you consistently take action on. So if you have a rule to take partials at a certain specific time, that does not mean you keep holding the trade and hope that it goes more into profit or more into whatever you're hoping for. Because you're breaking that rule and you're not creating disciplined habits. If your rule is to keep your stop loss above candle 1, candle 2 on a fair value gap, that means you put your stop up there. You don't put your stop inside of the fair value gap, because guess what? If it hits you out, then you're going to be tight. And then let's say it does go your way. You're going to do that the next trade, the undisciplined habit. So you want to do the disciplined habits, and then over time, you'll start getting payouts like Jadecap, bruh.
Is because of those small habits that I've made. Now, here's the reality. What I just showed you is a complete strategy. You can take this, apply it to the charts right now, and start seeing results. But I also know that when you're implementing something new, you're going to have questions. You're going to run into situations where you're not sure if that's a valid level, or if the confirmation is strong enough, or when exactly to take your partials.
So what does that mean? It means backtest, y'all. Whatever you're doing, whatever strategy you have, you want to be confident in that strategy. You want to know the ins and outs of that strategy. So that way when you execute, you're not second guessing yourself on if this is going to work or not. When you don't have confidence in your plan, in your strategy, you don't have confidence in your rules, running around in the street, running around placing trades in these markets. Every inversion FEG trade, you're entering on every displacement candle. You're doing whatever you feel like, when whole time you're still not even confident in doing that. Create a simple process, execute and manage based off of simple rules, and it'll become second nature. It'll become disciplined habits, and you won't second guess yourself if your system work or not. Whether you lose or win, as long as you followed it, you're straight. And ego doesn't get in the way like that anymore, because now you're just following that system, and you know in the long term that the shit's gonna work. Hope you guys enjoyed this reaction to Jadecap, most simple strategy. If you did, smash that like button. And if you're new to the channel, sub to the motherfucking channel, you know what I'm saying? But yeah, bro, enjoy y'all Saturday, bro. Peace.